Welcome back, everybody, to another deep dive.
Oh, yeah.
Today, we're going to be looking into the world of a true market maverick.
Right.
And we'll be exploring Reminiscences of a Stock Operator.
Oh, yeah. A classic.
It's a semi-autobiographical account of a trader who started very young, learned incredibly fast, and really left a lasting mark on Wall Street history.
This book, it gives us a peek into the world of early 20th century finance, really through the eyes of someone who just lived and breathed the market.
Yeah, and this is especially fascinating, I think, for learners because it really showcases how someone with no formal training
Right.
could develop such a deep understanding of market psychology and all those trading tactics.
Right. From the very beginning, the story starts with the narrator's childhood fascination with numbers.
Oh, wow.
So as a kid, 14 years old, he's working as a quotation board boy.
Yeah.
Scribbling stock prices on a chalkboard.
Wow.
But he didn't see them as just dollar signs.
Right.
To him, they were these constantly shifting numbers,
Hmm.
a puzzle that he wanted to solve.
So even at that young age, he's seeing like these patterns and relationships that other people are missing.
Exactly. He's obsessed with figuring out why prices move the way they do.
Interesting.
And this early focus leads him to his first wins, but not on like the New York Stock Exchange.
Right.
It was in the world of bucket shops.
Bucket shops. Now, that's not a term you hear every day. What were those?
So think of bucket shops as off-track betting, but for stocks.
Oh, interesting.
People would wager on price movements without actually buying or selling shares.
Okay.
It was fast-paced, risky,
Yeah.
but our narrator thrived in this environment.
So is that where he earned that nickname, the boy plunger?
It is.
Yeah.
He was known for making these large bets and winning most of them.
Oh, wow.
And his success wasn't from studying companies or poring over financial statements.
Yeah.
He was all about that price action, understanding that flow of orders,
Interesting.
anticipating where the herd was headed.
So he's almost more of a psychologist than a financial analyst?
Yeah, you could say that.
I don't...
He had a real knack for reading people, understanding their motivation and predicting their actions, which served him very well in bucket shops,
I bet.
where emotions ran high and fortunes could be made or lost so quickly.
Right. But I'm guessing this success didn't go unnoticed.
Of course not. Bucket shops started to realize the threat he posed, and they started putting handicaps on his trading,
Right.
trying to make it harder for him to profit.
Wow. So they're like changing the rules of the game to try to slow him down.
Exactly. They'd increase his margin requirements or charge higher commissions, anything to limit his impact.
Yeah.
But he was a master at adapting. He would even lose small trades on purpose,
What?
just to lull them into a false sense of security before hitting them with a big win.
Wow.
There's this great story about a bucket shop owner named Teller.
Okay.
This guy was ruthless,
Uh-oh.
and he tried to cheat him out of his winnings.
No way. I'm sensing a good story here.
Oh, it's a good one. So the narrator, he makes this sizable profit in Teller's shop.
Yeah.
But when he goes to collect, Teller refuses, saying the trade was invalid.
Oh, man.
Now, most people would probably just walk away,
Yeah.
but not our guy.
So what'd he do? Take him to court?
He did something much more clever. He went to a competing bucket shop across the street,
Okay.
opened a position mirroring the one Teller denied,
Oh, wow.
had a friend slightly delay calling out the price, quote.
Oh, man.
Then he closes both positions simultaneously.
Oh, he's creating like an artificial price difference.
Exactly.
In the shops.
Teller is forced to honor the original win.
Wow. What a move.
He exploited the system,
Yeah.
turned Teller's dishonesty against him.
Wow. That's great.
This story just shows his deep understanding of the game
Yeah.
and his willingness to think outside the box.
He certainly isn't afraid to challenge the status quo.
Nope.
But eventually he moves on from bucket shops, right?
He does. He sets his sights on the New York Stock Exchange,
The big leagues.
the ultimate proving ground.
Yeah.
But this transition wasn't easy.
What was the biggest difference he had to adapt to?
In bucket shops, he was betting on these momentary price movements.
Right.
On the NYSE, the execution of those trades, the time it took for orders to go through, added a layer of complexity he hadn't encountered before.
So it's like he was used to playing checkers,
Yeah,
and suddenly he's in the middle of this big game of chess.
a perfect analogy. He had to evolve his system.
Yeah.
He learns that true speculation requires a deeper understanding. Market trends, economic conditions,
Right.
and the psychology of other traders.
So a lot more than just quick profits.
Right. He had to shift to identifying those long-term opportunities.
That's a transition that even today a lot of traders still struggle with.
For sure.
Are there any notable mistakes that he made during this transition?
Oh, yeah. There's this story about a time he received a tip from a friend about Union Pacific.
Yeah, okay.
He goes against his own instincts and his analysis and shorts the stock based only on this advice. Unfortunately, Union Pacific declares a surprise 10% dividend.
Oh, no.
Right after he placed the bet.
Oh.
Which leads to a big loss.
A tough lesson, but probably a valuable one.
Oh, yeah. It shows the danger of letting those outside opinions really cloud your judgment.
Even if they're from a source you trust.
Exactly. He called it a cheap lesson in the grand scheme of things.
I like that.
It reinforced the importance of sticking to your own analysis and not blindly following the advice of others.
Right.
No matter how well-intentioned.
Or true.
He was starting to understand that true success in the market comes from your own conviction.
Trusting your own judgment.
Exactly. And this was a turning point for him.
Interesting.
He began to study those broader market trends.
Okay.
The economic indicators, the underlying forces driving long-term price movements.
So he's no longer reacting to just the noise.
Right.
He's looking for those signals.
The currents.
Currents.
That determine the true direction.
It's like moving from a tactical approach to a strategic one.
Exactly. He wanted the why
Yeah.
behind those price movements.
Right. Not just the what.
Exactly. And this shift led him to anticipate one of the most significant events in market history.
Which is?
The 1907 crash.
Wow. I mean, that must have been a defining moment.
It was.
Did he see it coming, or was it just luck?
He saw it coming. He recognized the warning signs.
Like what?
Excessive railroad financing. Tightening credit conditions that most people ignored.
Right.
He understood that the market was overextended. A correction was inevitable.
Yeah.
Many were caught off guard.
I bet.
But he profited by shorting the market.
It takes some foresight to go against the grain like that.
It does. And that ability to see the bigger picture, connect the dots, became a hallmark of his approach.
It's amazing. He's constantly analyzing and synthesizing information.
Looking for those subtle shifts.
Yeah.
The market's direction.
A student of the market. Always adapting.
Always learning.
This is already packed with insights.
Oh, yeah.
And we've only scratched the surface.
This is the beginning.
Can't wait to see what else we uncover.
Me too.
So he's a master at reading the market, seeing these major crashes coming, like the one in 1907.
Right.
But I'm curious, did he ever try to influence the market himself? We touched on his experience with manipulation in the bucket shops.
Yeah.
But did he ever use those tactics on the New York Stock Exchange?
He did.
He did.
But his perspective on market manipulation might surprise you.
Really? How so?
He didn't see it as inherently unethical.
Okay.
He actually thought it was sometimes necessary. Beneficial even.
That's an interesting take. How did he justify that?
He saw manipulation as a form of merchandising.
Merchandising.
A way to distribute large blocks of stock to the public.
Okay.
But to do it in an orderly fashion.
So less about deception and more about kind of influencing the flow of orders.
Yeah. Creating a smoother trading experience. He argued that large-scale buying or selling could cause wild price swings.
Disrupting the market.
Yeah, that natural equilibrium.
Okay.
So skilled manipulation could help smooth out these fluctuations.
Create a more stable environment?
Exactly. Make it more predictable.
Okay.
And he even gives a detailed example of how he manipulated the price of imperial steel using what he called graduated calls to achieve his goals.
Graduated calls? That sounds a little complex.
So imagine you're at a horse race.
Okay.
But instead of placing one bet, you place multiple bets on the same horse.
Okay.
Each with a different winning condition.
I see.
That's basically graduated calls.
Right.
Let's say Imperial Steel is trading at $40 a share.
All right.
He would buy call options.
Okay.
At a variety of prices, $35, $37, $40, and so on, up to a much higher price.
So he's essentially locking in the ability to buy Imperial Steel at a bunch of different prices.
Exactly.
Regardless of where the market goes.
Gives him control and flexibility.
I see.
Then, with a big chunk of those shares locked up through his call options, he could start to influence the price.
Okay. How so?
Strategically buy and sell shares. Create a sense of activity.
Upward momentum.
Exactly.
Drawing other traders in.
Push that price higher.
Very clever.
His goal wasn't to deceive the market, though.
Okay.
But to create that controlled environment where he could distribute a large block of stock without causing a sudden price collapse.
Right.
As the price rose, driven by this carefully orchestrated activity, he would start selling his shares against his call options.
Take profits.
Yep. Simultaneously supplying the market with the shares he wanted to offload.
So it's like a win-win.
Yeah.
He profits from the rising price.
Right.
Other traders get to buy into this seemingly hot stock.
That was the idea.
Pretty smart.
He stressed selling on balance, though.
Okay.
Never dump too much stock at once.
Right. Could spook the market.
Exactly. Undermine the whole operation. He compared it to walking a tightrope.
I like that.
That balance.
Precision and timing.
Exactly.
But this whole thing relies on other traders playing along, right?
It does.
What if they don't buy into the hype?
That's the risk.
Yeah.
In any manipulation.
Right.
He actually tells a story about a stock called Consolidated Stove.
Okay.
Where a bunch of promoters, blinded by greed and overconfidence, tried to manipulate the stock.
Yeah.
But they misjudged public demand.
Ouch.
Ended up holding tons of unsold stock.
Oh, man.
Big loss.
So even the most skilled manipulator can't completely control the market.
Nope. Sentiment can shift.
That bubble can burst.
The whole plan backfires.
It's a good reminder that manipulation, it can be profitable.
High risk, high reward.
Yeah.
And he saw this firsthand during the post-World War I boom.
Okay.
He observed this emergence of what he called boy bankers.
Boy bankers. Who were those?
They were young and inexperienced financiers.
Okay.
Rose to prominence during those boom years.
Flush with cash.
Yeah. And invincible.
Hmm.
But they lacked that wisdom and experience of previous generations.
Right.
Their overconfidence and speculation fueled this market bubble.
That was bound to burst.
Exactly.
Yeah.
And when it did, their empires crumbled.
Oh, wow.
A reminder of the dangers of unchecked speculation.
Leverage.
Yeah.
So even in a time of like growth and optimism, there were still people who saw the warning signs.
Absolutely.
The excesses beneath the surface.
He was one of them. While many were caught up in that euphoria, he saw the fragility.
Of a market built on speculation.
And borrowed money.
He saw those parallels.
Knew a correction was coming.
Couldn't predict when, though.
Right.
This long-term perspective, seeing past the hype, recognizing these cycles.
That seems to be a big theme for him.
A crucial lesson for any investor.
For sure.
Regardless of experience.
Markets move in cycles.
Right.
Understanding that.
Yeah.
Recognizing the signs.
Avoid those costly mistakes.
Capitalize on opportunities.
So he's wary of these boy bankers and their speculation.
Yeah.
But was he always just an observer? Did he ever step in to help anyone caught on the wrong side of the market?
He did sometimes. There's a story about how he rescued his friend Jim Barnes.
Okay.
Who was facing financial ruin from a bad investment.
In, ironically, Consolidated Stove.
Oh, wow. The same company.
The one from the manipulation scheme.
Full circle.
Barnes had a lot of stock in Consolidated Stove, facing a margin call he couldn't meet.
So he borrowed money to buy shares?
Yeah. And when the price dropped...
the broker demanded more collateral.
Which he didn't have.
On the verge of losing everything.
Yeah.
So did the narrator just lend him the money?
He took a more active approach.
Oh, really?
He orchestrated this perfectly timed price manipulation.
Okay.
Drove Consolidated Stove's price up just enough.
For Barnes to sell.
And avoid ruin.
That is a bold move, even for him.
It was purely out of friendship.
Or was there something else?
Well, he did care for Barnes. Yeah.
But he also had a financial stake in Consolidated Stove.
By
rescuing his friend, he protected his own investment.
So a forced liquidation of Barnes' shares could have triggered a decline.
Hurt his own position. Even in an altruistic act.
Yeah.
He's still playing the game.
Calculating.
Protecting his interests.
It speaks to his complex character.
It does.
This interplay of friendship, self-preservation.
And profit.
It really defines him.
Yeah.
A reminder that even the best traders aren't immune to the emotions of the market.
They make mistakes. They lose money.
And have to make tough choices.
That test their values.
Yeah.
Their loyalties.
This is so much more than just trading strategies.
It is.
This is human drama behind the numbers.
Yeah.
Ambition, risk, that struggle between fear and greed.
Shaping the market.
Since the very beginning. Yeah, it's fascinating to see how all of his experiences shaped his understanding of the market. But as the market kept evolving, you know, new players, technology changing, did his method still work?
Well, he did talk about how the growing number of companies made it harder and harder for any one person to really understand every sector or every opportunity.
That makes sense. The more information, the harder it is to separate the signal from the noise.
Right.
And that's something we deal with even more today.
Exactly. With the internet.
All the news and opinions.
The data.
It's everywhere.
He believed that in this environment, being able to filter that information to really focus on the things that drive price movements would be more and more crucial.
Yeah.
He was also concerned about the influence of these anonymous experts or insiders. What kind of concerns?
He was wary of these anonymous bullish statements.
Why different?
Prominent directors or well-known bankers.
Oh, okay.
He saw these statements as attempts to manipulate stock prices.
For their own gain.
Exactly, at the expense of regular investors. It does sound familiar, doesn't it?
Yeah.
Even today,
Right.
we see supposed experts making predictions, offering endorsements.
But with hidden agendas.
Conflicts of interest.
It's a reminder to always be skeptical.
Of those who claim to have the answers.
Especially when their interests don't align with yours.
Yeah.
He really believed that the public should be wary of these pronouncements and rely on their own analysis.
Their own judgment.
Yeah, he was a champion of informed speculation, urging traders to develop their own understanding.
Instead of following the herd.
Or the latest hot tip.
So as we kind of wrap up this exploration of this fascinating figure and his unique way of approaching the market, what are some key takeaways for us?
Well, I think first and foremost, he emphasizes the importance of becoming a student of the market.
Yeah.
A keen observer of price action.
He wasn't just gambling.
Right. He was meticulously analyzing those trends, understanding supply and demand.
Recognizing those signals.
That come before big moves.
He was like deciphering a secret code.
Yeah. A language most people couldn't understand.
That's amazing.
He believed that the tape...
The record of every trade.
Yeah, held the key to understanding the psychology of the market. A real-time reflection of the hopes and fears of all the participants.
Wow.
By studying it, you could anticipate the actions of others.
Understand their motivations.
Exactly.
And that leads to another point.
What's that?
Developing independent judgment.
Right.
He learned the hard way that relying on tips,
even from trusted sources,
could backfire.
Big time.
True success comes from
developing your own convictions.
Your own research.
Trusting your own analysis.
Even when it goes against the grain.
Exactly. He was always testing his assumptions.
Refining those methods.
Adapting.
The market.
The market's always changing.
Right. It's not just about being right.
It's about the process.
A system for making decisions.
That you trust.
Even when things are crazy.
Absolutely.
And that process needs to include
understanding market psychology.
Right.
Those emotional forces behind buying and selling.
Desire and greed.
Powerful motivators.
Yeah.
Understanding how they influence behavior gives you an edge. He wasn't afraid to exploit those emotions.
Yeah.
But he warned against becoming a slave to them.
Right.
Emphasized discipline and emotional control.
Especially during volatility.
Exactly.
It's interesting. He's this master manipulator, but he also champions independent judgment.
Ethical behavior.
Yeah, it's a paradox.
He was complex.
Operating in a different time.
Yeah.
But his insights are still so relevant.
Absolutely. The psychology of the market.
Observation analysis.
Emotional control.
Timeless.
Absolutely.
As we navigate today's market.
With all the speed.
The information overload.
It's good to remember that some things stay constant.
Yeah.
He believed that success comes from really understanding those forces at play.
Mastering your emotions.
Trusting your judgment.
It's a message that resonates even more today. When we're bombarded with so much information.
Questionable sources.
Learning to filter that out.
Find those valuable insights.
Is so important.
Absolutely.
So to wrap up, remember the lessons of this incredible trader.
Be a student of the market.
Develop that judgment.
Understand the psychology.
And be wary of those who claim to have all the answers.
Exactly.
And maybe, just maybe, you'll reach a level of mastery.
Like the boy plunger.
That's a great goal.
It is.
This deep dive has been incredible.
I've enjoyed it.
I hope everyone listening has found some valuable insights.
Some inspiration.
To continue exploring this fascinating world.
Absolutely.
Until next time.
Yeah.
Keep learning.
Keep exploring.